SoFi Technologies, ticker SFAI, is trading live at $32.52, and it is having an absolutely explosive start to the day. As of 10:11 a.m. Eastern Time, the stock is up $1.57, or just over 5%, on volume that is already approaching 20 million shares. The stock opened at $31.18 and has been on a tear, hitting a high of $32.73 just moments ago. That is not just a high for the day, that is a new 52-week high. The stock is officially in breakout territory, pushing past its previous high of $32.57. This is the very definition of price discovery, and it's happening on heavy volume, which tells you there is real conviction behind this move. The immediate-term story, the thing that is likely pulling in buyers this very morning, is that the market is finally digesting the fundamental shift that was revealed in SoFi's last earnings report. For years, the expectation around SoFi was that it was the student loan stock. It was the high-growth fintech that was just waiting for the federal student loan moratorium to end. That was the narrative, that was the bull case, and that was the bear case. The bears argued that without that one-time catalyst, the company's valuation was nonsensical, and the bulls argued that the restart would open the floodgates for its refinancing business. The reality, as it so often does, turned out to be far more complex and, for SoFi, far more constructive. What the market is grappling with right now is that SoFi is no longer just a lending company. The last quarterly report on October 28th wasn't just a beat, it was a validation of a new business model. The company posted earnings of 11 cents per share when Wall Street was only looking for 8. Revenue was a massive beat, coming in at over $961 million against an expectation of $887 million. But the most important number in that entire report, the one that is causing this breakout today, was buried in the segment data. For the first time, revenue from the financial services and technology platform segments, that is, the non-lending parts of the business, totaled $534 million. This now accounts for 56% of the company's total revenue. This changes everything. The expectation was that SoFi needed its lending arm, particularly student loan refinancing, to carry the weight. The reality is that the company has successfully pivoted to a diversified financial institution where its tech platform, Galileo, and its one-stop-shop financial services are now the majority drivers of the business. And it's not just growth at all costs. The company reported a record $139 million in GAAP net income. This isn't adjusted, pro forma, if you squint, it's profitable math. This is real, bottom-line profitability. That is the reality that is forcing a complete re-rating of the stock, and it's why we are seeing it hit new 52-week highs. Of course, this move hasn't been a straight line up. This stock is famously volatile, and it serves as a battleground for bulls and bears. Just look at the past week. On November 6th, the stock dropped a painful 9.68%. Then, on November 10th, it ripped higher by 8.26%. And today, we're seeing another 5% gap up. This is not a stock for the faint of heart. This volatility is a direct reflection of the tension in its valuation. With the recent earnings, the stock now trades at a trailing 12-month price-to-earnings ratio of around 59. The bulls will tell you that's cheap for a company growing revenue at 38% year-over-year. The bears will tell you that's an absurd multiple for a company that is, at its core, a bank, when the legacy finance industry trades at a PE of 10 or 15. This split is perfectly reflected in the analyst ratings. You have Needham and Citigroup with buy ratings pounding the table on the growth story. Then you have Keith, Bruyette, and Woods with an underperform rating, and Morgan Stanley has previously held an underweight rating, all pointing to that high valuation. The median price target from analysts sits at around $27.50. The stock is currently trading $5 or almost 20% above that median target. This tells you the stock is running ahead of analyst expectations, and it's retail and, more importantly, institutional conviction that is driving the price, not analysts playing catch-up. When we look at who is doing the buying, the story gets even more compelling. The latest institutional filings from the end of the third quarter showed a massive 20.9% increase in shares held by institutions. This isn't just hedge funds trading in and out. The most significant move came from JP Morgan Chase, which increased its position by a staggering 42 million shares, an 881% jump in its holdings. The Vanguard Group also added nearly 7 million shares. When you see giants like JP Morgan and Vanguard making nine-figure bets, it signals that the smart money is validating the new diversified and profitable business model. They are looking past the student loan narrative and seeing a long-term financial technology compounder. This is a good time to ask for your perspective. Comment below with your average cost basis on SoFi. Are you in the green today after this major breakout, or have you been holding for a long time? Now, we have to talk about the other side of the trade. With this much debate, you know there is a significant short position, and there is. According to the most recent data from Nasdaq, as of the end of October, there were 110 million shares of SoFi held short. Fintel reports a similar figure of just over 100 million shares. This represents about 8.5% of the company's float. While 8.5% is not a high GameStop-level short interest, 110 million shares is a massive nominal bet against the company. The short seller thesis is almost certainly not a bet that SoFi is a bad company. It is a pure valuation bet. The shorts are looking at the 59 PE ratio, looking at the slowing macro environment, and betting that this post-earnings enthusiasm is overdone and that the stock will have to revert to a more traditional bank-like multiple. But for those investors online, particularly on Reddit and X, who are looking at that 110 million share short position and hoping for a short squeeze, it is critical to look at the rest of the data. This is an actionable insight for you. You can find this data on platforms like Fintel or directly from Nasdaq. Two of the most important metrics for a squeeze are the days to cover and the borrow fee rate. SoFi's days to cover ratio is only 1.4. Because the stock trades with such enormous daily volume, regularly 80 or 90 million shares, shorts can cover their entire position in less than 2 days. This makes a sustained squeeze very difficult as there is plenty of liquidity for them to exit. Second, the short borrow fee rate is only 0.41%. This is an extremely low, almost negligible cost. It means shares are plentiful and cheap to borrow. If a squeeze were imminent, this rate would be spiking to 20%, 50%, or even higher. The current data suggests the shorts are comfortable, not trapped. They are placing a long-term valuation bet, not panicking. This brings up the second question that I have for you. What's your take on the valuation? Is a 59 PE ratio justified by the 38% growth, or are the shorts at 100 million shares right that this is just overextended? Let me know in the comments. So what does SoFi actually do to justify this? The company has positioned itself as the one-stop shop for ambitious professionals. It started with student loan refinancing, but using its bank charter, which it acquired in 2022, it has aggressively expanded. It now offers SoFi Checking and Savings, which offers a high-yield APY, SoFi Invest for trading, stocks and ETFs, SoFi Credit Card, personal loans, and home mortgages. The entire strategy is to acquire a member through one product, like a high-yield savings account, and then cross-sell them multiple other products, dramatically lowering its member acquisition cost over time. The third quarter results, showing 3.5 million new members, prove this is working. On top of this, it owns Galileo, a technology platform that provides the back-end infrastructure for many other fintech companies and neobanks. This is its high-margin software-as-a-service business that provides a stable non-lending revenue stream. Looking forward, the expectation versus reality framework remains key. The expectation is that the company must continue to execute this cross-sell flawlessly. The reality is that it operates in an incredibly competitive environment. Its checking account competes with JP Morgan and Bank of America. Its investing app competes with Robinhood, and its lending business competes with the entire banking sector. Furthermore, while the student loan business is no longer the only story, it is still an important one. New legislation like the One Big Beautiful Bill Act discussed in Washington proposes phasing out federal Grad PLUS loans by 2026. This could be a significant headwind, or it could be a massive opportunity, forcing graduate students into the private market where SoFi is a leader. The risk is that a deep macroeconomic slowdown could hurt its personal loan origination, which is a major profit center, and increase defaults. So as SoFi stock punches through a new 52-week high, the narrative has fundamentally changed. The expectation was that this was a high-growth, unprofitable student loan company. The reality, confirmed by the data, is that it is now a diversified, high-growth, and, most importantly, GAAP-profitable financial institution. The market is no longer pricing it on a hope of future profits. It is now being forced to value it on actual profits. The breakout we are seeing today is that realization in real time, as the bears who were shorting it based on the old unprofitable narrative are being forced to reckon with a new, profitable reality. The question is no longer if SoFi can become a sustainable business, but simply how much a business growing this fast with this much potential is truly worth.